My name is Joe Brusuelas. I'm the chief economist at RSM. I've been from about 11 years. And so what I want to do today is I want to talk to you rather than at you, because my part of the species, economists, love to talk at people. You might notice there's no PowerPoint here today. And I want to tell you, for an economist, it's a little like going swimming with no suit, right? The tide eventually goes out and they get to see what you got, right? All right, so let's have a little talk about what's going on in the U.S. economy. I'm going to try to tailor it to what goes on around here and things that board members might think about, right? So the Federal Reserve today cut its policy rate by 25 basis points. Now, 25 basis points doesn't mean much to your average human being. It means their 21.1% credit card rates may go down, a couple pennies. Maybe they'll get a little bit of a cheaper car loan. Housing, not really so much, right? But here in the Bay Area, where it's the global capital of tech, low rates, liquidity, and leverage are everything. 25 basis points can mean tens of millions of dollars like that overnight because of the way things operate. The heart and soul of how the tech community operates is separate and distinct from the rest of the U.S. economy. And I think this is going to be increasingly the number one subject of what boards are going to be considering in terms of overall governance and how personnel policies are developed. And we'll have a little bit of time to I think, address that, right? Now, what's interesting is that the American economy is a $30 trillion dynamic and resilient beast. It's unlike any other economy in the world, unlike any other economy in history. And our economy now can function in a different way. The 7 big hyperscalers, $350 billion this year committed to building data centers. Did you guys see the American-British tech agreement that the president put forward today? $41.2 billion is going to go directly in the UK economy, which has been stagnant and non-productive since Brexit. This is a big deal. $41 billion probably doesn't seem like a lot here, but in that $4 trillion economy, it's a major event. So things are beginning to move. And the U.S. economy is slowing because we're going through some inverse supply and demand shocks. The first one is trade and tariffs. The second is immigration. And the combination of that is causing growth to slow from around 3% to what we think is about 1.5% this year. But the rate cuts, the one you got today, the one you're going to get in October, and the one you're going to get for Christmas in December, will be accompanied by full business expensing, which is something that I know here in the Bay Area is a major and very important thing, as well as the tax cuts down market that are going to occur will put a floor underneath the economy. And we're expecting an acceleration to around 2 to 2.5% next year. So the economy is not going to go into a recession, but it will slow. It'll slow materially. And there will be some adverse asymmetric distributional shocks that are going to happen in different industries, right? The yield curve is resetting downward, but steeper. What that means is net interest margin is going to improve, and risk appetite will return to both banks and businesses. You might have heard via the Wall Street Journal or on financial television, mergers and acquisitions, IPOs, are beginning to stir, especially amongst the big companies. Within about 6 to 12 months, that begins to bleed through into the real economy. And then you get some velocity going, right? And then we begin to see a lot more risk-taking down in the middle market, which we define as 30 million to 10 billion, 8 different segments. With the sweet segment between 2 and 5 billion, that's where the growth is going to happen in the mid-market economy going forward over the next decade. If you haven't heard that before, it's not a surprise. We went into hard tax data that was available from the IRS in the middle of last year, and we found some really interesting things about our market space. So what's driving the economy? Tech and healthcare. right? One's acyclical. The other, well, actually, both are acyclical at this point, right? It doesn't really matter whether we're growing at 3% or we're growing just above zero. Those two sectors tend to do well. One's demographically driven, the other's demand driven, right? So the growth dynamics really are looking quite, I think, promising, despite the noise coming out of the policy sector. We try to separate out the finance and economics from that. Well, clearly there's going to be a problem. Labor is going to remain tight for a long time. Each month, we only need to generate about 50,000 new jobs to keep the labor market stable. So even as hiring slows, you're probably not going to see the unemployment rate above 4.5%. And if enough people are deported, the unemployment rate may begin to decline. And then there may be some wage pressures. That's one of the risks around the outlook later this year, but really in 2026 and 2027. And because the tech sector is immigrant sensitive, there's something that you'll want to watch close, right? I'm not too sure how much further they can go before we create some adverse shocks in the industry. And we know we're having problems in agriculture, construction, and manufacturing just due to the loss of workers. I know down in San Diego, 100,000 kids didn't show up for school to start the year. My wife's a professor at the University of Texas, and we were at a meeting and we found out we had about 25,000 kids that didn't show up in Austin, and they're primarily immigrants who are worried about getting deported. So these things do matter, and we try to sterilize it to take the poison out of the discussion, and we just use the term like adverse supply shock. It's perhaps not as sensitive as we might like to be, but it's how we have to do this these days. So we don't expect the unemployment rate to move much above 4.5% and then begin to retreat early next year. So the labor market is going to remain tight. Hiring is likely to be a bit uneven for a while. Again, if they deport enough people, we might have negative numbers, but the unemployment rate might not. And it's also important to note, every day there are 11,000 baby boomers retiring. The demographic transition is a serious thing that you don't want to underestimate, especially when you're thinking about governance and boards. That transition away from a baby boomer-driven model to the demands of the millennials and Gen Z. I'm a Gen Xer. We always sort of knew we were going to be overlooked. So I'm flexible either way, right? But the exit of the boomers is a serious thing. And we track that because demographically it's important. It drives so much of what we think about in terms of the labor market. All right, what about inflation? Inflation's rising. Tariffs are an import tax right now that firms are paying. And we're seeing about, 86% of the tariffs or so are being paid by the firms. We think sometime next year, consumers will start to feel it. It will take about 2 years for firms to pass through those tax hikes down to consumers. It's what happened the last time we did this, when tariffs went from 2 to 5%. The effective tariff rate, that's sort of the median tariff on all goods entering, is about 9.75% today. That's up from less than 2% in January. And it will peak, we think, around 18% by the end of November. Now, your mileage will vary based on what industry you work with and down to the NACD code, what product you're importing. But it's easy to say, 45% of all things we import go into things we manufacture here and then turn around and export. Import prices were up 0.4% this in August, but export prices are up 3.4% on a year-ago basis. When you tax imports, you tax exports. And that's part of the adverse supply and demand shocks that the economy is absorbing because of the change in trade policy. Now, I'm an economist. So if you have a trade deficit, you add on the inflows of capital, it equals zero. But the current administration thinks that they need to narrow the trade deficits for their own reasons. So that's what's going to be causing the micro and macro distortions until we work through this, right? And it's going to take a number of years. So inflation, is going to be about 3% at the end of the year. A little bit higher if you look at what we call the personal consumption expenditure. That's what the Fed uses to set monetary policy. The CPI is going to be right around 3%. And my sense is that we'll all get used to 3 to 4% inflation here over the next couple of years. It's just not going back down. And that's got to do with explicit policy choices, very sticky demand for things like services. And again, the economy is in a very different place. It resembles what I saw in the late 1990s more closely than 2000 to 2020. And so the inflation is just going to be there in a different way. What that means is we've had a regime change in interest rates. So the long run real neutral interest rate, once you account for inflation, is about 1.4%. So that means you should be sitting around 3.5% on the nominal rate. And indeed, that's where we think it's going, is that the Fed wants to move to somewhere between 3 and 3.5%. So that'll be the front end. And then you should get used to 4% or higher on the 10-year. And that would imply out along the curve 5.5%, which is where we think mortgage rates will eventually settle in. And I'm not one of those economists who's going to talk about mortgage rates or the mortgage market in a universal sense. I'm not going to insult your intelligence. If you live here in the Bay Area, you live in your own private universe, right? It's just a different thing. For many years, I lived in Manhattan, and we had similar but different dynamics, and it was always a big difference. All right. So on housing, we haven't built enough housing across the country since the great financial crisis. Right now, we're building about 1.3 million at an average annualized pace, and we're going to be stuck there until we get either a national housing policy or unorthodox policies put forward to pull down interest rates at the far end of the curve. You're going to hear people talking about yield curve control, the Fed restarting mortgage-backed security purchases on television. You should have, if you watch it, they're talking about it. It takes about 3 to 6 months to percolate down, and the public will start talking about it too. Okay. So when we think about what's driving the economy, it's clearly tech. The big thing is the integration of very sophisticated technology into the production of goods and provision of services. Artificial intelligence, agentic AI, is clearly at the tips of everybody's tongue. RSM has made $1 billion commitment over the next 3 years to integrate cutting-edge technology into the provision of our services. We're going to be focusing on efficiency and productivity. It's literally going to change our company. And as we explain that to our board, the questions are natural. They come fast and furious. What does this mean for our people? It means technology is going to replace labor. Let me give you an example. So the reason why I'm still employed as an economist is I'm very good in crisis situation, and I know how to estimate the optimal interest rate of just about any country. And so I started working with Perplexity, which is one of the better platforms, last year. And I said, hey, I'm going to start training it to do some of the technical work I do. And so if you're interested in estimating the optimal interest rate of the United States, you can use something called a Taylor rule. The economist John Taylor down at Palo Alto at Stanford, he was down there at CEPR. You can estimate this. Now, in order to do it, you have to know what the long-term neutral interest rate is. You have to be able to estimate it on your own. And you have to be able to estimate full employment or the non-accelerating rate of inflation and employment. And if you can do that, I can ask the agent on Perplexity to estimate the optimal rate using R star of 1.37 and full employment of 4.2. And within about 2 minutes, it gives me exactly what one of my models would say. When I was a graduate student at USC doing my PhD work, that would take me an entire day on an Excel spreadsheet 30 years ago. Productivity is everywhere except in the statistics, right? This is going to alter what we do and how we do it. If I was to hire somebody out of school with a PhD, I'd have to pay him $200,000 to $250,000 to do exactly what I just asked Perplexity to do. And it does it in less than 120 seconds, right? So I like to use that as an example because it's from real life, pulled from the headlines, pulled from real life. I've been working with this platform for a good time now. And I've had it read my work to the point where I can have it summarize my work and it sounds like me. And I can put things out having AI assist me in a more efficient way, which really for me helps because I have to fly all over the world, right? I tried to get here from St. Louis yesterday and ended up getting here this morning. It was just one of those travel days, right? But I was able to do something on the train that will publish tomorrow morning that I actually was AI assisted. Right? So we're integrating these things into our careers, into our lives, right? And I was an early adapter. I adapted to Amazon's electronic management program, where in my old apartment in New York City, it managed the HVAC and the lights, right? That's very early on. I loved it, right? And today we built a house, and when we built it 3 years ago, or it was 2021 when we built it, the first question I asked was, they asked me, the builder was, what ecosystem are you going to have manage the home? Right? Legitimate, right? And they're just about finished with the development. It's on the east side of Austin. It's about 2 miles from the core downtown. And it's where the old airport used to be. The last 6 houses are being constructed by 3D printers. It's one of the most fascinating things I've ever seen, right? It's really, really something to behold. So we're advancing in such a way that the internal dynamic properties of the economy are going to structurally adjust. We're going to get very productive. We're going to get very efficient. And those who are involved in that are going to see greater returns, right? Whenever you get a rate cutting cycle started, like probably started today, usually you see equity markets go up by about 15% over the next year. We did that basic research and I thought, equity markets are up 17.2% this year. I think it's already happened. Why? Because of what we were just talking about. All right, so I've talked at you for a little bit of time. The economy is going to continue to grow a little bit slower this year than we like, but it will accelerate on the back of rate cuts, full expensing, and tax cuts next year. The unemployment rate is going to stay unnaturally low, really between 4.2 and 4.5%. Labor is going to remain tight, and if we get more noise out of the policy sector, there may be second-order wage pressures beginning to build in again. Here in the Bay Area, you guys know how to manage that better than any other metro in the country because of the ebb and flow of tech and how sometimes labor is short. You have to import it, and you have to import talented labor, and that comes at a price. Inflation, you should get ready for 3 to 4%. The era of 2% inflation's over for a good period of time. Embedded in the Fed's summary of economic projection, they don't even think they're getting back to inflation at 2% until near the end of the decade. So that really gives you a sense of what's going on. We expect the front end of the curve, the 2-year, which is pinned to the Fed funds rate, will move towards 3% early next year. We think out at the long end, you're going to be sitting around 4 and then 5.5. And that, I think, is a sweet spot where if we can get mortgages, anywhere near 6 or below, then we'll start to see a recovery in housing, right? What would you guys like to talk about? Because it would seem to me as board members, there's a lot here to unpack, especially around what are we going to do with the personnel? We'll go right to you in a second. Oh, yeah. Women 25 to 54 with 2 years of college would seem to me the most at risk because of the efficiencies embedded in AI and agentic AI and what it could do. Marketing, HR, administration. Yeah.
You're right on point with what I was going to ask about. If we are retiring 11,000 people a day who are highly experienced, highly skilled. And on the front end of the labor force, you have a lot of entry-level positions being replaced, supplanted by AI. Where and how do the new college graduates or new trade school graduates go to get their skills and experience to become that middle experienced force down the road? And what's the long-term impact to our economy as a result of this, I guess, disparity or, disruptive wave?
So the economy is going to grow. It's going to be productive, but it's the people that we're going to have to tend to. I don't think we're going to see the recessions in the same way we saw them in 1945 to 2005. When the great financial crisis happened, the economy fundamentally fractured and never healed properly. And up through those fissures is where tech went. And tech's now structurally transforming the entire economy to the point where good people with good skills are unemployed out of college. And so internships, apprenticeships, non-traditional entry into the labor market will probably become a lot more important, right? I wouldn't be surprised if there's demand on firms as we begin to see technology replace this labor to help them with the transition financially. Meaning some sort of a retraining maybe on the table as we move forward through this. Now, I'm speculating here because this is what I hear when I go to Washington once a quarter.
So follow up.
Yeah.
So this disruption that you're discussing, but you kind of just threw off, well, the economy is going to grow. Well, the economy relies on consumers. And if these people are out of work and there's no social safety net, where is the economic activity that's fueling this growth in the economy?
They'll find jobs. But it's a little like the problem with housing right now. When I bought my first house, it wasn't in Beverly Hills, it was in Hollywood, and there were hypodermic needles on the sidewalk. And I used Fannie Mae and Freddie Mac to sponsor it, right? Because I didn't have the capital to do it. So I moved into a non-desirable area to build wealth. It was what was called a starter house. Something similar is going to happen with jobs for some. Now remember, with all these people retiring, labor is going to be dear for the next generation. They'll find jobs. It may just not be the one they want. Okay, and this is what's really important. We've got a K-shaped economy. And it's been like that my entire life. I'm in my 50s. But it's gotten to the point where the upper 10% of households is responsible for 49.2% of all spending. If I widen that out and I look at the upper two quintiles, the 40%, it's 65% of all spending. So when I say the economy is going to continue to grow, it's going to prosper, it's going to become efficient, unfortunately, the economic imbalance that's causing a lot of the polarization socially and politically is widened. The chasm is widened. It's widened to the point now where that upper 40%, every 3 months, they hit the accelerator and you see these big numbers. And the economy will likely just continue to grow and expand. Even though there's going to be profound transformation down market. And income is going to be dynamic. Firms that we've grown to know and love are at once important and then 20 years barely exist. 20 years ago, I used to think the world of General Electric. Anybody ever hear about General Electric anymore? No, it's going to be dynamic. The assumption that things are going to be static and not change, we need to have those discussions internally inside companies and on boards. Change is the only constant in modern commerce. And we can't state that enough. Other questions? Other people? Thank you, Tim.
I thought it was really interesting that you said that the boomers are starting to move out, but they're exited. I feel like they pretty much exited because I'm Gen X as well, and I'm at retirement age myself. So I feel like that's kind of That's already passed a little bit.
So there's 90 million of them. You know, there's
So
a
there's
little under 45 million of us.
Yeah.
We're a small trickle. They're an ocean.
Yeah. So there's more.
Yeah, there's a lot of
Yeah.
that still left to exit.
So what do you think about then also related to the boomers is the wealth transfer
Yeah.
from the boomers to the millennials? And how do you see that kind of playing into
Well,
some of
we
these
got
dynamics?
into it during the pandemic, didn't we?
Mm-hmm.
When we unfortunately lost a lot of boomers, and you saw the tip of the spear in the wealth transfer, what did the kids do? Quit work.
Mm-hmm. Yeah.
They strived for work-life balance.
Yes.
They refused to come into the office.
Yeah.
They wanted flexible hours. Okay, we sort of have an idea now, I think, of how this is going to go, which is why I'm not too concerned about those kids. They'll find jobs. It just won't be the ones they want. But they need to get the experience, right?
I'm worried about productivity, and especially with immigration and issues.
The immigration issue is significant.
Yeah.
If you pull 2 to 3 million people off the workforce, it's going to have an impact. That's going to be adverse economically and financially. Productivity. You know, it's been a lot stronger over the last few years than it has been in a quarter of a century. They're moving around 2 to 2.5%. We were stuck between 1 and 1.5 for a generation, and it's starting to accelerate. And I think it's because we're integrating these things into what we can do. 3 years ago, I hired an economist here in North America, and he's a PhD level economist, but they're all data scientists at heart. There's one I'm going to talk to next week, and I'd love to keep her in North America, but because she's of Indian origin, she just finished up at the University of Georgia, she has to go back. Now, this is a young person who would have been paid $200,000 to $300,000 a year if she stayed. She's going to make $20,000 to $30,000 a year in India. But it's her skill sets, machine learning, Python, neural networks, the things that they can do quantitatively make them just distinct and uniquely valuable. So we're going to be thinking about that mix going forward, right? If we don't have the proper mix, well, we're going to have to outsource, right? And if we can't find that, then we're going to have to go directly to technology substituting for human labor. And that comes with its own unique set of issues that boards have to think through, right? Because managing the forward public view on that's going to be something that none of us have the background to do or the precedent to rely upon, right? So it's good that in these forums we begin having talk about these things amongst friends, right?
Question over here, but maybe before we get there, where you were saying the integration of tech with, I guess, the production, real step change. A lot of folks, especially in the venture world here, say is going to happen when AI integrates with robotics. And your example earlier about the home being built down your street by robotics, AI and robotics mixing with one another could, in theory, solve a lot of the problems from like production productivity cycle, but also could create a lot of problems from an unemployment, lack of jobs. And I think there certainly be a lot of opportunity for people here in the Bay Area to participate in the upside of that K economy that I spoke to earlier, but the dispersion and disaggregation of where people win and lose is different depending on where you're at in the country. Any thoughts on regional effects or any of the aforementioned and how all of that may interplay, because the dollars are going into AI and robotics, it appears at the moment.
The coolest thing about my job when I came to the firm was I got out of the glass tower at 59th and Lexington in New York City. I got to get out around the economy and see how things function. Our world here is separate and distinct from where I was the day before yesterday in St. Louis. You live on the upper spur of the K, they live on the lower spur, and the two rarely intersect, right? anytime you have a positive productivity shock, right, or technological, an era of innovation that results in wholesale efficiencies, the gains are always asymmetrically distributed. They're not distributed evenly. It's just like trade. And that's why boards want to think about this. We're having a populist revolution right now over the perception that free trade caused job losses. It didn't. It was productivity. We produce more with less people. Over the last 2 years, I've gotten to go to the chip factory outside Scottsdale and the chip factory about 20 miles from where I live in Tyler, Texas. They are magnificent. And there's hardly anybody working there because it's all robotized, right? I mean, there's a lesson to be learned there. And Tyler, you're right on it, right? I mean, that's what Taylor's getting to, is that there's going to be an equitable distribution of resources. And it's important that we think through what that means for our companies, right? Who we're hiring, why we're hiring, who we're firing, why we're firing, right? And it's good that you ask hard questions of CFOs and CEOs about how they intend to manage it now and 5 years into the future, because it's going to accelerate. It's a good thing for the economy. It's a natural transition. You know the old story, turn of the 20th century, we still had 60%, I believe, of the public working in industries related to agriculture. We're now down to about 3%. Right? We have 163 million people working for us. We produce more volume than we ever have, even if our market share of manufacturing's declined. But the volume's up, and that's because of productivity and efficiency. So it's there, right? What else do you guys like to talk about? Right.
Yeah. I'm Chitra. I come from tech. So the one challenge we are seeing now is 10 years ago when cloud emerged, there was one cloud and then came the second and then came the third. It was a staggered growth. Whereas with AI, you see a lot of innovations coming all at the same time. And there is a great prospect for consolidation down the line, right? You never know which AI will survive, how many will survive, the mortality, we are seeing it as such. And another problem that I see is the billing aspects, right? When you enhance productivity with these AI technology has not evolved to bill to the cost of utilizing this AI as well. That's another area we are still innovating. My concern for the board is, if we are letting go of people thinking that productivity has been accomplished with ABC AI, what happens with consolidation? What happens if that productivity is more expensive than how we would have achieved that with human labor?
Well, it's the doppelganger of what goes on in the rest of the economy. Lululemon was one of the best products I ever saw. They set their shops always up within 100 yards of an Apple store, and they knew that upmarket women between 25 and 54 who shopped. And for a generation, they didn't get it wrong. They overexpanded. Well, we all know about the paper from MIT that says 95% of AI is not going to make it. Well, for the non-initiated, that's something to be frightened of. As an economist, I'm like, well, that's what you call creative destruction. That's the dynamic properties of capitalism. It's exactly what we want. That's the basis of the foundation of the entire Bay Area economy, by the way. Joseph Schumpeter. That's right. We need to have that happen. So boards have to ask real, tough, forward-looking questions about how you manage the risks around overexpansion or cutting too many people. The way I think about it is we need to have automation simultaneously with augmentation. There are going to be people who just don't want to manage the AI. I've had discussions with very senior members at my own firm. They're just not interested. Okay, that's fine. You have to leave. Because I've got these Gen Zs and millennials who naturally get this. And it's time we put them in charge, right? You can just unpack what I'm saying and really think through labor policies around Gen Xers and boomers. Even the older millennials, some of them won't want to do this, right? So yeah, you have to ask those hard questions. Where are we investing? Why are we investing? How long before we see the return on yield, right? Or the yield on investment, right? Those are 3 basic ones. And we're going to make big mistakes. We all remember the dot-com crash. We developed these amazing things that we didn't have the bandwidth to use. It caused a pretty long-term disruption to U.S. financial markets, in particular in the NASDAQ. But 10 years later, it set the stage for the boom, right? So, yeah, this just goes along with business. The assumption that things are going to be static needs to be let go. Things are going to be dynamic. And inside AI, it's geometric change. The example I gave earlier, I couldn't do that 2 years ago, but I can do it now. Right? And I thought, well, maybe 5, 7 years. No, it came much quicker. And we can, I can have it make data visualizations now. I mean, literally, AI can replace an entry-level $85,000 a year person who has a master's degree. Okay, this gentleman, and then we'll come to you, okay, Martin? Oh, sorry. Yes.
Hi, my name is Indrajit. I'm actually an entrepreneur, 3 startups in Silicon Valley. I came here as a student. I'm wondering, the tech economy is driving 40% of the NASDAQ.
Yeah.
Probably more than that in the S&P 500. Tech is driven by people like me.
Yeah.
People like me are not coming into this country anymore.
Yeah.
Capital will be chasing people like me outside this country.
Yeah.
What's the impact of that in the long term to the economy?
Immigration is the secret sauce behind the success of the economy. We're going to face long-run challenges unless we come to a honest and rational policy organized around the need to import external workers. Period. End of sentence. I have no more to say on that. It is what it is. Right? And if we don't, well, then the Indians will pass us up, or the Chinese will pass us up, or the Brazilians, or the Malaysians, or the Indonesians, right? There's a lot of opportunity out there, and the world is flat, but people are smart, right? What I always tell people who think, oh, come on, you're exaggerating. I'm like, catch the next flight to Singapore. Go down to the financial district. It's the equal of Wall Street. It's the capital of derivative settlement since the Chinese decided to screw up Hong Kong. And then come back and we'll have a talk if you think, there is no alternative to us. Oh, there's a lot of alternatives to us. Yes.
I was going to ask you about the education aspect, the crisis in the colleges. And I'm on a few boards at the universities, and they absolutely have no clue what to do. They've got tenured professors. They're trying to find more money elsewhere. Many of the companies I know say, I don't want anyone going to college. Many of the entrepreneurs say, don't go to college. We'll train you here. It's kind of like patents. You used to file a patent and you gave more information away and it was just useless. So now you just move more quickly. What's the fate of higher education, and where do you think the talent will come from and the training will come from for those that do make it into
So
business?
we've had an ebb and flow in education in this country. It's a long-term thing. Typically, you have inflation shocks. Students then choose not to go to business or to go to school because financing is too expensive. And that, to me, is what's happening. But then we get inflation back in the box, and then people go back. One of the reasons why I hire economists who also have data science training is I love the data scientists, but they're prisoners of the black box. There's no judgment. Whereas the economist will say, no, there's a margin of error here, and there's external factors, exogenous factors. We need to use our own judgment augmented by the amazing things we can do technically, right? The large language models, the huge data sets. Education won't go out of style, but it too is going to be disrupted. And disrupted in a significant way. My wife is a professor at the University of Texas. She teaches at the graduate school. She teaches user experience, which is a 30-year-old discipline on the edge of business, technology, and the social behavioral revolution. We were very fortunate. Summer before last, I won the lottery to get tickets for the Olympics in Paris. So we decamped to Paris for the summer. And we're sitting at a wonderful cafe on George V, and where the Seine is, and we're having some tea, and she looks at me and she says, "Well, I did all this to get this job so I could teach at the graduate school, but my discipline's going to be gone in a couple of years because of the advances in AI." This is a professor who got to that exalted 12 hours a week where they deal with really bright people who are getting their PhD. She doesn't have to deal with the snotty-nosed 18-year-olds who are, right? Yet she turns to me and says, yeah, so her and my brother are doing a startup. They're creating a virtual reality to learn foreign languages. It's amazing what they're doing. We got the Apple headset, and I wear it all the time. And I can literally dance on a floor and hit a tile, and a word comes up, and it will teach me to speak French or German or Spanish. That's what's happening, is the really bright people on the edge of tech and psychology and business will just go out on their own. That, to me, is when the university system starts to lose their advanced labor. That's when the problem hits. And so they need, you're going to have to think laterally on this. It's just not going to be demand and tuition and foreigners paying full price, right? Which is the thing, right? I did my doctoral degree at USC. I mean, what if they were about 30%, I think, right? We had the lady over there you were sitting next to who wants to ask a question. Are we done?
Last one, Lisa, is that okay? Yeah. If anybody would like to chat with Joe after, we'll be hanging around. Michelle.
Thank you. Just to build on that one, I'm curious if you could talk about the value of business degrees and both undergraduate and graduate and kind of these classes of folks that used to go through, whether it's Goldman Sachs or McKinsey or Anderson, and if all of that is just sort of a thing of the past because you don't need to pay $85,000 for someone with a business degree when ChatGPT can do it.
This is the Achilles heel of tech, where tech can get very short-sighted. The idea that you don't need to learn to think critically, to write, to communicate, to know the classics of Western civilization is erroneous. The business schools, in many ways, are the most well-positioned to change due to the dynamics out in the private sector. I don't think that will go out of style. It may become smaller, right? When the housing market peaked in December 2005, I had one of the most impressive professional networks of bankers who worked on Wall Street, economists, financiers. When the financial system came close to collapse and the housing market did fundamentally break and it still hasn't healed, the headcount on Wall Street was down 40% within 36 months. People who I considered good friends disappeared into the ether. Sometimes we have positive productivity shocks as opposed to depression-like shocks, and things change. That community is likely going to narrow a bit. But those people who go there are very bright. They will find other things to do, right? Great question about the cloud. 2015, the number one job demand in New York City was cloud computing. The Bureau of Labor Statistics didn't even have a NACD number for it because it was so new. That cloud engineer was the thing. All of my wife's students then, that was the one, they were going to become cloud engineers. Now I understand not so much in demand. Why? Because 10 years later, the internal dynamics, the creative destruction inside the fundamental structure of capitalism has caused us to move on. My wife's user experience is going to be enveloped by AI. So she's just moving on. She tells me her and my brother and her have a $150 million a year idea. And I'm like, yes, you do, because I need a sugar mama. I'm tired of flying around the world and talking to people about this. I want to sit at home and watch baseball. All right. On that very encouraging note, Thank you.
Yes, and
I'll turn it over to Lisa.
yeah, real quick, if anybody would like to follow Joe or any of his team's insights, you could sign up to our monthly Real Economy newsletter. That covers a lot of macro and a little bit of drill down on industry-specific topics, but then we also have material that is probably more catered to you and your individual fact pattern. If you'd like to chat with us after this, we'll be here, or if you'd like an individual follow-up at a later point in time, certainly happy to make any of our economists available to you to help you with your forward thinking. Thank you, Joe.